Rahul Malani is also joining us. He tracks the banking space very closely at Sharekhan. Rahul, by now you must have really looked back, I would say, at the commentary of some of these PSU banks, which seem to have made parts of the market nervous. But then they say that that's not the only overhang. The quality of PSU bank results so far have been towards a softer side. What are you reading on these 2 points here?
So basically, on the ECL provisioning front, it will be too early to build a forecast over the next few years. However, if you look at in case of private banks, top private banks as well as the top PSU banks, including SBIs and the BOBs of the world, they have additional contingent provision which are outside PCR, and they are standing at around 1%, more than 1% of the overall book. So if we believe that even if the additional cost is on the higher side, it would be absorbed over the period of 5 years, and banks have existing contingent provisions, and moreover, will be applicable from FY25. So overall, they get in the next 2 years the incremental contingent provisions, which could be built in the near term to absorb that higher cost, because currently the credit cycle environment is expected to remain benign at least for the next 1.5 years, and there is no possible incremental stress which is seen in any of the portfolio, or say for example in any of the segment also. In terms of lower tier PSU banks, yes, the impact will be higher because they don't have additional contingent provisions. But over the next 2 years, they could build their in the light of the benign credit cost cycles, they could build incremental provisions on the same. And whatever the Canara Bank had mentioned, I had quantified around 5% of the total ECL provisions which will be required. So it was not an incremental basis; it was on a total basis. So we believe that incremental provisions could be built in the next 2 years to absorb that higher cost.
Sure, I get your point that this is perhaps a knee-jerk reaction, too early to start baking it into the target prices, etc. But is it fair to assume that there are no triggers going forward for the PSU banking names? Because last year and at the start of this year, we have already seen a big run-up. The credit cycle is softening a bit. We are hearing the commentary of credit growth also tapering a bit. Your take, whether there's further upside, and if yes, which are the stocks that is towards the top recommendations from you?
So yeah, you have correctly alluded that we also believe that there are no levers left for the core ROA improvement trajectory from here on. So in that context, the current valuation level seems to be fully present. Because if you look at SBI at the top PSU bank, if you take the POB, current valuation level seems to be fully priced in all the positives. Near-term triggers lacks for the re-rating for the whole sector as well.
Okay, Rahul, on that note, we'll let you go. Appreciate you joining us on the show.